Hey, in this video we're going to look at how much home can you buy with an income of $50,000, and we're going to look at it using conventional financing. Okay, so stay tuned because we're going to go over a bunch of numbers, and before we get into it, I do want to say, hey, if you have any questions in general about financing and lending, hey, check out the links below. Get in touch with me. I do work with a number of really great lenders here in Las Vegas. And just to qualify, or a disclaimer about this video, is I'm not a certified lender, but I am a licensed real estate agent. So all the figures and numbers in this video are just for your education and for informational purposes only. These are not hard figures. So when I go over these numbers, don't think you're pre-approved if you have an income of around 50,000 based on what I'm sharing in the video. You're not. This is just for your education. It's just going to give you a rough idea, like they talk about a ballpark figure. So that's what we're doing here. And if you really want to find out how much home you can be qualified if you have an income of around $50,000, you need to go talk to a lender. And so again, check out the links below, get in touch with the lender, and they're going to go over, there's a lot of things they need to go over to find out exactly how much home you can buy. Okay, so with that said, let's get into it. So another disclaimer is I do have a number of figures written down on a pad right here, so I'm going to be looking up and down during the video. So firstly, the first thing to talk about, we're going to talk about conventional financing, and we're going to assume you have a good credit score of over 700, let's say around 740 or even better. That's going to influence the amount of home you can buy. As you may or may not know, the better your credit score is, it means you're going to have a lower interest rate on your mortgage. And obviously the lower the interest rate means you can get more home, because your monthly income that you can put towards the mortgage, there's going to be more of that can go to purchasing the home. So if you're not sure about that too, check out the link above. I go over that in another video about credit scores, and if you do have a bad credit score, how to improve it and how that's all related. So check out that link above. So let's get into it here. So we got $50,000 income. How much home can we buy? 740 credit score. So we're going to go over three different scenarios with a conventional loan, and one is putting 3% down, and one is putting 5% down in a down payment, and one is putting 10% down in a down payment. So they're typical options. There's also, you could go to 20% down, but we're just going to use the 3, 5, and the 10. Okay, so the first thing we're also going to do is, there's a really important concept in determining how much money how much house your money will buy is separate from your credit score, is also called the debt-to-income ratio. So that's also really important in determining how much home you can buy. And so we're going to go over two scenarios. One where you don't really have, any monthly debt. And some people are in that situation. We're talking about things like a car loan, a monthly car payment, student loans, and credit cards. They're the three main areas people usually have some kind of debt. And so one scenario we're going to consider you don't have any debt in those areas. And then the other scenario we're going to consider you have around $450 a month. That's somewhat typical. Some people are higher, but for example, you might have a $300 a month car payment. You might have credit cards, somewhere around $50 a month, and you might have student loans, around $100 a month, or some kind of scenario like that. So we're going to go into those two scenarios. So firstly, let's talk about a 3% down using $50,000 income. How much home can you buy with a down payment of, the minimum down payment is 3% down. So firstly, the first thing to do is you're going to figure out how much $50,000 is per month. So $50,000 comes to around $4,167 a month. So that's your monthly income. Now, with zero debts, then when you use conventional financing, the debt to income ratio that they use is 45%. What does that mean? Well, debt to income ratio, again, if you're not sure what all that's about, check the link above. I go into all that in another video. Check that video out. But basically, let's just use round figures for this example. First of all, let's say you make $10,000 a month. What's 45% of $10,000? $4,500. That means a lender is going to say you can only use $4,500 of your $10,000 a month towards your loan payment and including any other debts you might have to pay off. So in a situation where you don't have any other debts, that means you can use that full $4,500, which is 45% of your income, towards a mortgage payment. So that's the basic idea of it. So in this example, we said our monthly income of $50,000 is $4,167. So what's 45% of that number? 4,167 is $1,875 a month. This is assuming you have no debts. So if you have no monthly debt and you can use the full 45% of your monthly income towards your mortgage payment, that means your mortgage payment can be $1,875 a month. $1,875 a month. And I'm going to put some little slides. I have an app on my phone where I from a title company, which is kind of a quick and easy calculation of how much home you can afford. It goes into all the different things, like your mortgage payment contains not just the principal on the home, but also taxes you have to pay on the property. You have to pay homeowners insurance. You have to pay, in this case, mortgage insurance. And so they call it PITI, principal, interest, taxes, and insurance. So if you're using $1,875 a month, that's the maximum amount you can use for all those things, the PITI, principal, interest, taxes, and insurance. That means your home that you can buy would be $245,000. That would be the maximum amount of home you could buy with a $50,000 income, putting 3% down, with a 45% debt to income ratio is $245,000. Now, these are round figures. The actual figures, might be $245, $370.81, but we're not going to get into that. I'm just rounding the figures out to make this video a little easier. And like I said, you don't take these to the bank. This is for educational purposes only. So, $50,000 income, zero debts in your monthly income. Get you $245,000 roughly of home, putting 3% down. Okay, so what about in the same scenario, but you have debt? You have $450 of monthly debt. Well, what that means is you're putting 3% down, and something else to say here, the 3% down, I'm assuming right now interest rates are around 6.25%, 6.125%. So when you put 3% down, we're going to assume your interest rate's around 3.25% or 6.25%, which is 6.25%. 3% down, a 6.25% interest rate with a debt to income ratio of 45% means your monthly payment can be $1,875 a month, which means you can buy $245,000 of home. Okay, now when you have $450 of debt, that's the other scenario, car payment, credit card, student loan, something of that nature. That means your monthly income, which was $1,875, now you have to subtract the $450 of debt from that $1,875 a month that you can use towards your mortgage payment, because the debt to income ratio means that 45% of your income can be used for your mortgage and any other debt. So if you have $450 of debt, that means now $1,875 minus $450 is $1,425. That means your monthly maximum amount of your mortgage payment can only be $1,425 a month. So $1,425 a month at a 6.25 interest rate, 3% down, gets you $190,000 of home. So that's $50,000 income, 3% down, no debts, $245 a month. $245,000 home, $450 of debt a month gets you $190,000 of home. So you can see a big difference there. That's actually $55,000 difference in home purchasing value. That the difference between having $450 a month debt and having no debt means you can get $55,000 more of home when you don't have any debts. So you can see how important getting your debts down to as little as possible. Okay, so that's the first scenario, $50,000 income. What about if we put 5% down? So the more you put down, you get better interest rates, and you actually obviously have to pay less on your mortgage, so you can buy more home. So that's the basic way it works. You're going to see this in a minute. Okay, so if you put 5% down, a $50,000 income means you've got $1,875 a month you can use for your mortgage payment. Now your interest rate's slightly less, 6 1/8%, 6.125. That's going to get you $260,000 of home. That's $15,000 more dollars of home between putting 3% down and 5% down. So you put 2% more down, but you now can get $15,000 more dollars of home. That's interesting. Okay, now what about, let's go to the other side when you have the $450 a month of debt. So 3% down, it was $190,000, but 5% down, you can actually get $205,000 of home. So that's an increase of $15,000 as well. So that's pretty interesting. Let's go up to 10% down. 10% down, we're going to also use the interest rate of 6 1/8, that's 6.125%. So you've got the monthly income of $1,875, you put 10% down on the home. That's with an annual income of $50,000. Debt to income ratio of 45%. That gets you $270,000 of home. That's with zero debts in your monthly income. Now, if you have the $450 of debt in your monthly budget, that means you can buy now $215,000 of home. Okay, so let's do a quick summary. I know that's a lot of numbers I'm jumping at you, but here's the basic pattern. The more you put down, the more house you can buy. And when you have the less debt you have, the more house you can buy. So let's just do a quick recap of these figures. $50,000 income. That means with zero debt. That's $1,875 a month you can put into your mortgage. That's the 45% debt to income ratio. Okay, 3% down, it gets you $245,000 of home. 5% down, it gets you $260,000 of home. And 10% down, it gets you $270,000 of home. So that's a big difference between 3 and 10% down. You can see that's a difference of $35,000 of home by putting a little more down at the beginning. Now let's go to when you have a monthly debt of $450 a month. That means your monthly income of what you can put towards the mortgage has dropped from $1,875 a month down to $1,425 a month. With that $1,425 a month, with 3% down, it gets you $190,000 of home. When you put 5% down, it gets you $205,000 of home. And when you put 10% down, it gets you $215,000 of home. Okay, so if you put 5% down, a $50,000 income means you've got $1,875 a month you can use for your mortgage payment. Now your interest rate's slightly less, 6 1/8%, 6.125. That's going to get you $260,000 of home. That's $15,000 more dollars of home between putting 3% down and 5% down. So you put 2% more down, but you now can get $15,000 more dollars of home. That's interesting. Okay, now what about, let's go to the other side when you have the $450 a month of debt. So 3% down, it was $190,000, but 5% down, you can actually get $205,000 of home. So that's an increase of $15,000 as well. So that's pretty interesting. Let's go up to 10% down. 10% down, we're going to also use the interest rate of 6 1/8, that's 6.125%. So you've got the monthly income of $1,875, you put 10% down on the home. That's with an annual income of $50,000. Debt to income ratio of 45%. That gets you $270,000 of home. That's with zero debts in your monthly income. Now, if you have the $450 of debt in your monthly budget, that means you can buy now $215,000 of home. Okay, so let's do a quick summary. I know that's a lot of numbers I'm jumping at you, but here's the basic pattern. The more you put down, the more house you can buy. And when you have the less debt you have, the more house you can buy. So let's just do a quick recap of these figures. $50,000 income. That means that's with zero debt. That's $1,875 a month you can put into your mortgage. That's the 45% debt to income ratio. Okay, 3% down, that gets you $245,000 of home. 5% down, it gets you $260,000 of home. And 10% down, it gets you $270,000 of home. So that's a big difference between 3 and 10% down. You can see that's a difference of $35,000 of home by putting a little more down at the beginning. Now let's go to when you have a monthly debt of $450 a month. That means your monthly income of what you can put towards the mortgage has dropped from $1,875 a month down to $1,425 a month. With that $1,425 a month, with 3% down, it gets you $190,000 of home. When you put 5% down, it gets you $205,000 of home. And when you put 10% down, it gets you $215,000 of home. Okay, so that's a lot of figures. Check out the link, the description, and because I go over this, I put down these numbers in the description there. But you can see the pattern here. Better to have less debt than more, and the more you can put down, the more home you can get. So that's $50,000 income. One more possibility to look at. Let's look at putting 20% down. So a $50,000 income, we've gone over 3%, 5%, 10% down. So we see the pattern clearly here. The more you put down, the more house you can afford. So if your mortgage payment's maxed out at the same amount, well, it's pretty simple when you think about it. Let's just use a simple example of a $100,000 home. So if you're buying $100,000 a home and you put 3% down, $3,000 down, that means you still owe $97,000 on the home. But if you're putting 20% down, $20,000 down, now you only owe $80,000 on the home. So, there's two ways to go here. If you only owe $80,000 as opposed to $97,000, you can either mean you're going to have a lower monthly mortgage payment, because if you're only paying off $80,000, you don't have to pay as much in each mortgage payment each month. Or you can max out your mortgage payment to the same amount as if you were doing a 3% down, so that you can buy more home. So that's kind of how that works. So here are the numbers right here. For 20% down with zero debt, we'll go for the zero debt first, you can buy yourself around $320,000 of home. $320,000 with 20% down. And here's something interesting that we can look at. I'm going to put right now on the screen both the phone card for 20% down and 3% down. And you see when you put 3% down, there's both for zero debt. You can afford about $245,000 of home. You have principal and interest, taxes, insurance, but you also have what's called PMI, that's private mortgage insurance. And that private mortgage insurance is about $165. However, on the 20% down, you don't need to put down private mortgage insurance. So that's a general feature when you go up to 20% down. Private mortgage insurance is separate from your homeowner's insurance. The private mortgage insurance, called PMI, is for the bank, for the lender. It gives them insurance that you're going to pay back the loan in case you default. They're going to get the payment back. But when you put 20% down, you don't need to have PMI. So right there, as opposed to 3% down with $165 payment a month, now you're saving about $165 in that compared to 3% down. And even when you go up to 10% down, it's close to $100. So you're saving between $100 and $150 in your monthly payment, and that $150 can also go to getting more home. So that's a good deal when you put 20% down. That's a big difference. $245,000 with a $50,000 income, putting 3% down, as opposed to $320,000 with the same income, the same credit score, just by putting more down, you can get almost $100,000 more of home. Well, in this case, it's like about $85,000 more. That's a lot. That's a big difference. So think about that. Then let's go take a quick look at the other side where you have some debt, the $450 of debt a month. So if you put 20% down with $450 of monthly debt, the amount of home you can get is $250,000. So that's a good deal. When you put 3% down with with a $450 a month debt, you can get $190,000 of home, and now you can get $250,000 of home. So that's $60,000 more dollars of home you can get just by putting more down. And again, in that case, you don't have any PMI. You don't have, in the 3% down, you had about $130 of private mortgage insurance. So that again, you can, when you go 20% down, you don't need to pay that. So that can also go into paying more for your mortgage, more home that you can buy. So, that's really interesting, so when someone, asks the question, how much home can I buy with a $50,000 income? I hope you can see the answer is, it depends. It depends on a lot of factors, like what's your credit score? This credit score, we're assuming you have a good credit score in the 700s. If your score was, close to 620, the interest rates that I quoted here, which are the current interest rates today, would be higher, maybe by a full percentage point, which means you're going to have less homes. So the $320,000 home might be closer to 280, 290, or 300, depending on what the interest rates are. So, there's a lot of factors. And just by changing the amount that you can put down, you can see what a difference. 3% down was 245, 20% down was 320. And then also the debt to income, how much debt to income ratio. You have a difference of $320,000 home with a $50,000 income, assuming you had no debt, putting 20% down. And when you had $450 of monthly debt, putting 3% down, you could only get $190,000 of home. That's a $130,000 difference with the same income. $130,000 more home just because you had less debt and you put more down. So $50,000 income with a 740 credit score, having no debt, you can get 10% down, you could get $270,000 of home. If you put 20% down, that's going to go even up more. It may even go close to $300,000 of home. So I hope that was helpful. Again, this is only for educational purposes. This in no way means you're pre-qualified. This is not a pre-approval video where if you have this much money, you can go out now thinking you're pre-approved to buy a home for that much. That's not what this is about. You have to go to a lender and talk to them to find that out. But this is just for your education, give you a rough ballpark idea of, I have this much money every month, roughly how much home can I buy for that? So I hope that was helpful. And again, check the link. Check all the link in my description to talk to lenders. Also check out the description below for the numbers, because there's a lot of numbers in this video. It'll be helpful. And hey, leave me a comment if you have any more questions. I love it when you leave me a comment. I might make another video for you, or I'll try to answer your question for sure. And I work here in Las Vegas as a real estate agent. I'm not a mortgage broker, but if you have any real estate questions, I'd love to help you. And again, if you found any of this to be helpful, do me a favor, smash that like button, hit the subscribe button, and stay tuned for the next video. Thanks for watching.